What's going on, everybody? Michael Silva here. We're going to talk about today the start of the next leg lower in the financial markets, some key critical levels that we're noticing, the Fed giving and the Fed obviously taking back away. All that and more on today's Stock Market Brief Show. If you're new here, welcome to the show. We use technical analysis and inter-market analysis to get a good idea as to where the market might be headed next. Make sure to hit that thumbs up. It is greatly appreciated. And subscribe to the channel if you haven't done so already. Let's get into it. Alrighty, everybody, welcome back to the show. This is the daily chart of the S&P 500, and I'm showing you a couple of things here on the screen. First and foremost, the last video we talked about this evening star reversal pattern, and it had the possibility of coming back down to that lower weekly expected move to around that 3,900. Well, we tagged that 3,900 today, which is a critical level, because that level right there has acted as a level of support and resistance many times all the way back. Here you can see just on my screen towards May. And then the 4,200 is up here, which acted as a level of resistance and support multiple times. So we've been kind of bouncing back and forth through this area. Now, if we start breaking away from this 3,900, that could be quite critical and important data that we need to be well aware of. Remember, today's drop came also on some big volume. Remember, the Fed, Bostic, came in and just gave us this rip and rally over here. Powell steps in and he taketh thee away. Now, if we're taking a look at the weekly time frame on the S&P 500, we are at a critical level here too as well. Right here, this line represents the anchored VWAP from the October bottom. And you can see price action was just up there earlier this week, and now we're right back down here. Now, it hasn't fully broken quite yet, but we do have important data coming out tomorrow, which I'll get into. But as it stands right now, remember, we are coiling up, and while we coil tighter and tighter, it could create an explosive move to the downside. It could also create an explosive move to the upside. Markets move between expansion, right? Expansion, boom, 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 to contraction, and then we see those moves take place. If we take a look at the 15-minute time frame, this was the daily expected move, and you can see we clearly went 2 sigmas outside of the daily expected move, and we're also outside of that weekly expected move. Now, 2 sigmas is pretty rare. Well, how rare? Well, it only happens around 4% of the time. Remember, 68% of the time it closes within here. Well, 95% of the time it will close within its 2 sigma move. Now, if we go into tomorrow's expected move, we're looking now at a $5.68 expected move. This is what the market is pricing in based off of tomorrow's catalyst. And the catalyst is non-farm payrolls and the unemployment rate. So what does that look like? Well, that can take us down here to 385.88 to potentially up here to 397.24. Yesterday's expected move was about $3. Today, it's significantly higher. Okay, so moving on. If we start to get a move higher, be aware that we're still below the month-to-date anchored VWAP, we're below the week-to-date anchored VWAP, and we're now below a 5-day moving average, right? We've been below that, and as we start to lose data, right, so we have, so let me do here, 1, 2, 3, 4, 5. This day, all this price action that went up, we're going to start losing that. So this is going to start turning back around. So if we have the month-to-date turning back down, we have the 5-day turning back down, the bears are still currently in control. Okay, so as we've stated, we're at a critical juncture point at 3,900. Okay, that's on the SPX. We're at a critical juncture point here on the SPY at that lower anchored VWAP from the October bottom, and we're basically right here, as you can see. So come tomorrow, if we get some decent news or the market interprets it as decent, like this would be the area to potentially bounce. But where can we potentially bounce to? That's why I would say pay attention closely, back up into this area, which is the lower expected move. Remember, 68% of the time it finishes there within the week, but dynamic hedging clearly is taking place as we started breaking outside of that, pushing price further down. So what can create this potential next leg lower in the markets, we'll get to momentarily. Now, we first need to look at the 11 sectors that make up the S&P 500, and the one that took the biggest hit was financials. Remember, financials are a key critical piece in the S&P 500. And what we get into later on today's show, you'll see that there's been a very rare thing that has occurred. The 2 sectors that led the way, both were down was utility and consumer staples, and those are more obviously defensive sectors. Why are financials doing bad? Well, we've been talking about yields, right? We've been talking about this yield curve inversion going steeper and steeper into inversion. That is something to obviously continue to pay attention to. Now, what do I want to talk about with financials? XLF, it took a monster hit, right? Down 4.06%. We'll just call it 4% with some monster volume. So what really drove it? Well, we can take a look at regional banks. This thing was down 8.11%. You can look at Wells Fargo, Bank of America. They were huge, huge hits. Another big one was SVB. You may have heard that one in the news. This was down 60%. Apparently, this was the 16th largest bank in the United States. I saw that somewhere on Twitter. I don't know if that's actually correct, but that is a huge blow to its market cap. Silvergate, another bank here, went down another 42% on the day. I want to look at KRE more specifically, looking at its rate of change, so down 8.11%. This right here does not happen frequently. You can see it's been here, boom, boom, right, a couple of times there, back in 2011 to 2012, and in the Great Financial Crisis. These dates, they should look familiar, because when we see this type of volatility in financials, well, guess who stepped up to the plate each and every time? The Fed. What do I mean? Well, the Great Financial Crisis, when they stepped in. What is this? Well, it was between 2011 and 2012, right over here. Well, that's called Operation Twist. What happened here? Well, this was the pandemic where the Fed stepped in and did unlimited quantitative easing. So this doesn't mean necessarily the Fed's going to just change their narrative right out of the gate. But we could very well be approaching the next leg lower in the market, which could cause something to break, and the Fed right around the corner to potentially step in. When could that be? Hey, it could be next quarter. It could be the following quarter. But we need to be at least aware that this type of volatility, especially in financials, right? You can see potentially this is a, head and shoulders pattern breaking down. That could bring us down, boom, to roughly around this point right here, 42.5, which would be a monster move. And at that point, well, maybe the Fed might do something. We don't know yet, right? We can pretend that we know, but what we do know is what the Fed tells us. And the Fed has its foot on the gas to curb this inflation by lifting rates and by tightening. If we take a look at the monthly expected move, I mean, a lot of volatility, right? A lot of volatility. The Fed, they giveth, right? Bostic came out. We saw a big move down. Powell came in and just, made us have nightmares. So, but we're really only down 1.31% for the month to date, but back below that 5-period moving average. And we're not too far off from this red shaded area, which is what that red shaded area is, bear market territory, 20% from the top down to here. And you can see this lower expected move is for the month. That's 3,800. So we'll keep an eye on that. IWM, it's not the same story, right? They have a lot of financials and they have a lot of energy names in there that are important. This one took the big hit. So this one's down 3.6% for the month to date. Its lower monthly expected move we still haven't tagged, and that's just below that. It's like 178, right about there. 178, I'd say. I don't have the number in front of me. And then Qs, this hasn't even been budged, right? Month to date, yeah, we saw a lot of volatility, nice move up. It's down not even 1%, not even 0.5%. So where can we potentially see this? The lower monthly expected move is down there at about 275. The upper is around 310. And this dashed line right here, that's the quarterly expected move. So this quarter ends, right, this month. So is price going to close outside of it? Or remember, 68% of the time, it closes within these expected moves, and we're right there near the upper range for the quarterly expected move. Another interesting turn of events is looking at the safety trades. So this is looking at safety assets relative to the S&P 500. So if I take a look at gold, right, this is upticking back up through that 50-period EMA. That's relative to the S&P 500. If I take a look at XLU, it's starting to curl up here, not quite through that 50-period EMA, which could be a signal. XLP, it looks like it's about to start breaking through that, which means what? It means that we can potentially see continued outperformance of XLP relative to the S&P 500. This right here is TLT over S&P 500. This did trigger, and that to me is quite interesting. And the reason why this is interesting is because we're now, today, could be the start of seeing people go duck and cover, right? So where do people go for safety? Well, they go to dollars, they can potentially go to gold, and they go to bonds, which we did not see in 2022. So when I take a look here at TLT, right, this is just, there's many different types of funds. I'm just looking at TLT for an example. What do we got going on? Well, we have this bullish crossover on the price momentum oscillator. We have this, abandoned baby candle over here, which, hey, maybe that's insight to potentially the turning, right? We're still an overall downtrend, but now we're starting to kind of base out here. So if the 10-year yield comes off, which it did today, right? It was down, you know, today it closed at 3.93, which was down 1.26%, and that propped up the TLT, and we started to see that move up. So if the TLT starts catching a bid, this could represent, hey, we're going into more safety type scenarios. Okay, so that's what I'm paying attention to. A couple other things that took place today: the financials, right? The BP chart, the bullish percent index, got into pretty extended territory to the downside. The RSI is now 1879. The NYSE bullish percent index is back into oversold conditions. The BP SPX has a subtle positive divergence. You can see right here we have a lower low in the BP line, and then on the RSI a higher low there as well. And then we're starting to look at the percent of stocks above the 50-day moving average. Only 26% are above the 50-day moving average in the S&P 500. When it gets extended, it gets down to this 10% range, and that has marked some bottoms clearly here, little ones here, right over here, and so forth. So if this starts pointing down further, this could be a potential area to watch on this to mark a short-term, potentially long-term bottom in the S&P 500. The last chart I want to close off with is the Bitcoin versus gold. This is known as the Saylor to Schiff tool, something that we created quite some time ago. And this right here recently triggered. We talked about that last week, but we said that, sorry, it signaled last week, and we say, okay, to get the trigger, you need to have the price close below or get below the prior week. And clearly we got below it. And just take a look here as it triggered, bam, we start to see that flush there in Bitcoin. So this thing has been holding up very well. It's not a holy grail indicator. It has been working very, very well though. And you can see today, if you look at crypto equities, Bitcoin, Ethereum, you know, anything related to cryptos, Silvergate, right? You can, everything took a pretty large hit today, and this gave us that heads up in the market. So that's all I got for you on today's episode, everybody. I went over a lot. We are at some critical juncture points right here, but there's also some big warning shots on volatility. This is a time to be patient if you want to go long and have risk very, very measured. Remember, we're below these key little levels right here. If you want to be bullish, it'd be a lot better to see price recoup this and start to build bases. But as it stands, we're seeing a lot of volatility, and this potentially could be the start to the next leg lower. That's all I got for you. See you later.